Well, welcome to Ask Me Anything, our first session here on transition taxes. I'm here with Mark and Roman in our session, and we've been chatting a little bit, and I'm going to let everyone pick up in what we were talking about. Mark has had a question: have I seen 1202 in practice? And the fact is, yes, I have. Now, 1202 is an interesting section. It's the qualified small business section of the tax code. And you probably all know that C corporations are subject to double tax. First, the C corporation pays taxes on assets that they sell, and then when they go through liquidation, the shareholders pay taxes again on what they receive there. Now, if there is a stock sale, there's only one tax, which is on the gain of the stock. And what 1202 says, in order to encourage people to invest in C corporations, which your government likes, it says, if your C corporation qualifies, when you sell your stock, we'll give you a very special tax rate. And that tax rate is 0. And I don't know a single business seller that isn't after that tax rate. So it is very happy news when you see it. Where I've been able to use it, Mark, is where we've had a situation where the seller has a number in mind. I want to realize after the closing of the sale this much money. And we go over the fact that there's an eligibility for 1202. And the fact is that the selling price doesn't have to be as high as they had in mind in order to realize the same amount of money. So what happens is the seller becomes more flexible with the buyer, knowing that they have that great tax advantage.
Yeah, but on the other hand, you want your seller to get the full fair market value for his company, and if it winds up being tax exempt, oh, hallelujah, what a bonus.
Right, what a bonus. You get that extra maneuverability.
There's you can also get a nice deferral from reinvesting the proceeds in some of these, I think they're called enterprise zones. Is that right?
Yes, opportunity zones.
Opportunity zone. Thank you.
Typically, is what you're talking about.
Yes.
And that's a
Different topic.
Yeah, it's a fading benefit, because if you could take advantage of it when you were right away, you got much more immediate benefits. And if you talk to some of these 1031 aggregators, they Delaware statutory trusts, they have DSTs that specialize in opportunity zones. So basically you become in a partnership, if you will, and then those benefits of the opportunity zones get flow through to you. And so it's kind of a nice way. It's a little hard to invest necessarily in the opportunity zone, because they're not, if you're in an inopportunity zone, something that's doing well economically, it's not nearby.
Right.
Yeah.
So, you've got to go where others don't want to.
Exactly. So having the partnership is sometimes a good strategy. Now, Roman, you asked the question about deal structure.
Correct. Yes, and how various deal structures may impact the tax implications. Yeah.
Right. So there is a practice that we call deal structuring. That what you do is a seller comes to a tax advisor with a proposed deal. And we say, okay, here is the deal. And we take a look at that deal and we figure out what the tax exposure of that deal is. And then we start playing with the components of the deal. Now, we've already talked about asset sales versus stock sales. When you have a stock sale, there's generally just one asset that you're talking about, which is the stock. But when you have an asset sale, there are different categories of assets, and the IRS wants the deal allocated to the various asset classes. And the way you do that will then reflect on what your total tax bill is, because the taxes in different categories, some are gain, some are ordinary, and it makes a big difference. So what we do in deal structuring is we take that structure and we figure out, based on the deal you propose, this is what I would like to see. And we would come back, these are your taxes. And then we try to come up with at minimum at least one other scenario. Well, you don't have to do that. What if you, and then based on what we know of the principles, did something else? Then we can take advantage of deferments and reclassifications and reduce the tax structure, and we can show if you're willing to change the terms, not even necessarily the price. There's an old saying, you name the price if I can name the terms. Well, deal structuring takes advantage of that. If you're willing to be flexible in your deal terms, then you're going to improve your tax situation. And that whole approach of coming up with multiple scenarios that let us investigate the after-tax consequences of each scenario is deal structuring, just in general. Now, we had 2 questions that were put on the community website that were pretty deep, and let me read those to you and answer them, and you'll see in those answers some more of the materials of the things you talked about. The first one is, how do you see warranty and indemnity insurance established in transactions, and what are the typical factors that lead you to recommend a buyer put W&I insurance in place to protect against undisclosed tax claims? As I said, this is a great question, and I'm going to just do a tip of the iceberg approach. But as we've mentioned, it's important for advisors to be able to at least respond with the tip of the iceberg when they're faced with a question. Now, it's an example of an insurance product that has been around for a while, faded from use, and WI insurance now seems to be making a comeback. It, for a long time, was thought to be too costly. Now, I haven't personally used it, but I've been in situations where it really would have been of value. And let me give you some examples. The idea of the indemnifications is that even after you do the most complete due diligence possible, the target business may still be a minefield due to undisclosed liabilities. How can you recognize that possibility with taxes? One interesting way to do that is to pay attention to what the IRS calls their dirty dozen. They publish every year, sometimes late in Q1, the 12 areas that they see are the most problematic with income taxes and the ones that they are addressing with the greatest vigor. And what's most interesting is to see what's been added every year, because what they just added this year turns out to be a very likely landmine. So for example, this year, 2023, it was ERC mills. ERC is the employee retention credit, which compensated businesses that were hurt by COVID restrictions, but still kept their payroll going. The credits on ERC can be quite large, and there are companies who tell business owners that if you work with us, we'll get you the credit at no upfront charge and just take a small percentage, 10 or 15% of the credit. Now, if you see that on the books of a company and the ERC was taken using the business owner's normal tax professional, it has a probability of being okay. However, if someone's been using one of these services, the IRS has been reporting where there are many, many cases where it was taken, it was not correct, and the IRS plans, when they have enough time, to come back later on and get their money back. So if you see that, you want to ask your business owner who did this, to give you an idea if they're working with a mill. Just looking at the returns, one way to discover it is you can find 941X returns, which are your payroll tax returns used to apply for the credit, but not corresponding 1120X or similar income tax amendments that you're supposed to do, because the mills don't care about you doing that, but you must adjust both. Now, this only affects a stock buyer. However, there are also landmines for asset buyers as well. State and local taxes have characteristics not found in federal taxes. One is very complex nexus rules. Nexus rules define who qualifies as a taxpayer. And another is successor liability laws. Successor liability laws hold that an asset buyer and the seller are both jointly liable for taxes that were due solely from the seller. If all the seller's business was concentrated just in one specific location, it's easy to ask for a certificate of no tax due to protect the buyer. However, if the business is widespread, there may be too many potential tax jurisdictions to make this practical. So the seller can promise to make good on any back taxes that appear after the sale with an indemnification in the sales agreement. So let's suppose a buyer goes with that, and after the sale, an unknown nexus is uncovered by a tax authority. They will go after the existing business, as well as the former owner. The buyer can show they are indemnified by contract, but tax liability cannot be transferred by contract. If the seller who's no longer in business believes they can just ignore that tax authority, after all, they're no longer in business, the asset buyer can inherit that past tax liability. Wouldn't it have been nice for that buyer if the indemnity had also been insured? Absolutely. So if you've ever been in a deal that doesn't work for the seller as an asset sale, but the buyer is concerned about undisclosed liability, this may be another strategy to try to get the ends to meet. In summary, some tax factors that may call for W&I insurance include significant tax positions, either credits or tax shelters, and exposures to multiple taxing authorities. Now, if there are insurance professionals in the BizNexus community here who work with WI insurance, I'd love them to message me to see if we can take this topic even further. The second question that was asked was, outside of the usual stock versus asset dilemma on a deal structure, what would you consider the key items a seller should be aware of to reduce their tax burden as a result of selling their company? And Roman, this kind of is your question repeated a different way. It's been said a penny saved is a penny earned, 2 if they're saved on taxes. However, a lot will depend on what a seller wants to do with their penny. Just wanting to save on taxes is not enough. The advisor needs to factor in what the seller wants to do with those savings. If reinvesting the savings is a goal, there's a world of tax savings available. In the Transition Tax Radio workshop, I call these deferments. If the seller doesn't actually receive the sale proceeds, they may not be subject to paying the tax until they do receive them. This includes renting instead of selling, financing, exchanges, structured sales, if they have a charitable intent, charitable trust, many, many more. They just don't put all the money in their pockets at closing. The money goes right to reinvestment. The other considerations in the workshop are called reclassifications. Income is taxed differently depending on how it's classified. Changing classification often requires advanced exit planning. It's often not easily done, but it can be very powerful. It sometimes requires the combination of tax and legal and sometimes valuation expertise as we move asset ownership around and adjust them to different entities to take advantage of better tax rates. So in summary here, the key items are twofold. Is the seller consider reinvesting the proceeds? And is the seller open to professional tax planning? Which is really the heart of the issues with structuring any sales. I'll have to ask if either of you, if there are any questions. We actually went a little longer than I thought we were going to go, but I certainly appreciate your participation. Do you have anything else?
No, from my end, I think that was great. Yeah, so thank you.
Thank you, Roman. I see Mark's on the phone there, so I will wish everybody well. And I believe this is going to be a monthly event here at BizNexus. Feel free to add questions on the community website and join me here next month. Thank you.
Thanks.